Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Mastering Market Risk, a guide for smart investors. Ever find yourself wondering why your portfolio isn't performing as expected? Market risk might be the culprit. In the fast-moving finance arena, understanding market risk is crucial. It refers to the possibility of investment losses due to factors affecting the entire market. These could range from economic shifts to political events, and they can alter your investment outcomes drastically. Ignoring this risk could lead to unexpected losses. This video will guide you through the essentials of market risk and equip you with strategies to navigate it effectively. Stay with us to discover how market risk impacts your investments and how you can stay ahead of the curve. Defining market risk. Market risk is an unavoidable part of the financial world, affecting everyone from the most seasoned investors to those just starting. It's the chance that the value of investments will decrease because of wider economic changes. Recognizing this risk is like spotting warning signs on the road. It helps you prepare and adjust your investment strategy to help protect your financial future. Understanding market risk isn't just about knowing it's there, it's about grasping its types and how it stands apart from other risks. Types of market risk. Market risk comes in various flavors, each impacting your investments differently. Let's break it down. Equity risk. This refers to the potential loss investors might face when the market price of a stock falls. For example, if you own shares in a company and its stock price declines due to poor earnings reports or market conditions, that's equity risk impacting your portfolio. Interest rate risk. This type affects investments in bonds and other fixed income instruments. When interest rates rise, the value of existing bonds typically falls. This happens because new bonds will likely offer higher yields, making older ones less attractive. Currency risk, also known as exchange rate risk, this comes into play when dealing with international investments. Fluctuations in currency values can influence returns. If you're investing in a foreign market and the currency of that market weakens against your home currency, your returns might decrease even if the investment performs well locally. Commodity risk. This affects investments tied to commodities such as oil, gold, or agricultural products. Prices in these markets can be volatile, influenced by supply and demand factors, geopolitical tensions, and natural events. Market risk versus other risks. Market risk is only one piece of the financial risk puzzle. It's crucial to distinguish it from other types of risks that can affect investments. Credit risk. Unlike market risk, credit risk is about the possibility that a borrower won't fulfill their obligations. It primarily concerns bond investors who worry whether a corporation or government will default on its debt. Operational risk. This risk arises from failures in a company's internal processes, systems, or controls. Think of it as the risk from the day-to-day operations going awry due to mistakes, fraud, or system failures. Liquidity risk. This involves the ability to buy or sell assets without causing a significant impact on the asset's price. If you hold an investment that's difficult to sell without reducing the price, you are facing liquidity risk. Each risk category has its own characteristics and methods of mitigation. Knowing how they interact and influence your portfolio is key in crafting a diversified and resilient investment strategy. Understanding market risk, in particular, empowers you to navigate the ups and downs of the financial world with confidence. Factors influencing market risk. Understanding what drives market risk is crucial for investors. This section uncovers the factors that stir up uncertainties, leaving no stone unturned. By exploring these influences, you can better prepare to weather financial storms and maintain a resilient portfolio. So, what exactly impacts market risk? Economic factors. Economic shifts play a major role in shaping market risk. It's like watching the tide, seeing how high or low it gets. Here are some key players. Inflation. Rising prices can erode purchasing power, affecting savings and investments. When inflation spikes, central banks often hike interest rates to stabilize prices, which can lead to market volatility. Interest rates. When interest rates change, they send ripples across the financial landscape. Rising rates can squeeze profits, while falling rates might boost borrowing and spending, impacting everything from stocks to bonds. Economic growth. A booming economy can drive stock prices as companies see higher earnings. However, if growth slows, fears of a recession can unsettle markets. Investors need to stay on their toes, ready to adjust strategies. Political factors. Political dynamics are like the wind, sometimes unpredictable but always influential. Understanding these can offer useful insights. Political stability. A stable political environment nurtures confidence in markets. But unrest, like protests or coups, can rattle investors, leading to sudden swings in stock prices. Government policy. Tax changes, subsidies, and trade policies can either fuel growth or create hurdles. For instance, a sudden trade ban might impact a company reliant on exports, affecting its share price. Regulations. New regulations can be a double-edged sword. While they might protect consumers and ensure market fairness, they can also add pressure on businesses, affecting profitability and investor sentiment. Market sentiment and behavioral factors. Ever wondered why markets sometimes seem illogical? It's often due to human psychology. Investor sentiment, greed, and fear drive market swings. When investors are optimistic, stock prices rise, sometimes beyond reasonable value. Conversely, panic can trigger dramatic sell-offs. Market psychology. Crowd behavior often amplifies trends, leading to bubbles or crashes. A herd mentality can push prices to extremes, much like a flock of birds suddenly changing direction. Recognizing these factors empowers you to make informed decisions, keeping an eye on both numbers and narratives. Whether it's economic currents, political winds, or psychological tempests, understanding these elements helps you navigate the ever-changing sea of market risk. Measuring market risk. Grasping how to measure market risk can seem like trying to predict the weather. It's complex but not impossible. Investors use specific tools and methods to gauge potential losses and prepare for financial storms. Let's dive into some of these techniques. Value at risk, VAR. Value at risk, VAR, is a standard tool that tells you the worst-case scenario over a specific time frame. It's like knowing how much rain to expect before you leave the house. VAR provides a monetary amount that represents the potential loss you could face. For instance, if a portfolio has a one-day VAR of $100,000 at a 95% confidence level, there's a 5% chance that the portfolio will lose more than $100,000 in a single day. How is VAR calculated? Calculating VAR typically involves three methods. Historical simulation. This method relies on historical data to estimate potential future losses. It's like using past weather patterns to guess tomorrow's forecast, assuming history might repeat itself. Variance-covariance method. This method assumes a normal distribution of returns and uses the standard deviation to calculate risk. Think of it as predicting outcomes using a bell curve that indicates how much returns deviate from the mean. Monte Carlo simulation. A more sophisticated approach. This uses computer-generated random sampling to simulate a wide range of potential outcomes. Imagine running countless weather simulations to cover all possible future scenarios. Each method has its strengths and weaknesses, but together they help investors set guardrails for risk management. Stress testing and sensitivity analysis. Stress testing is all about pressure. No investor wants surprises, and stress tests simulate financial shocks to see how a portfolio might react. It's like testing an umbrella in strong winds to ensure you won't get soaked when the storm hits. Why stress test? Stress testing prepares you for market upheavals. By simulating extreme conditions like market crashes or rate hikes, you can identify weaknesses in your portfolio and make necessary adjustments before trouble strikes. This is crucial for financial institutions and individual investors alike, as it provides insights into potential vulnerabilities. Sensitivity analysis. Testing the waters. Sensitivity analysis digs into how different factors impact your portfolio. If stress testing is about surviving a storm, sensitivity analysis is like checking how sensitive your skin is to the sun. It reveals how changes in market variables, such as interest rates or currency movements, affect your investments. By understanding these tests, investors can pinpoint which factors are most likely to pose risks. Armed with this knowledge, they can devise strategies that align with their risk tolerance and financial goals. Measuring market risk might feel like gearing up for battle. But with tools like VAR, stress testing, and sensitivity analysis, you're not just bracing for impact, you're building a shield. So stay proactive and ensure your investment strategy is as robust as possible. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.